Bidding wars and bully offers back in Toronto's housing market. Sort of. While the market across the GTA is still very slow, there are a few pockets where activity feels aggressive, where bidding wars are the norm, and where we're seeing buyers making bully offers. And just to be clear, a bully offer is an offer submitted before the scheduled offer date, usually well above the seller's list price. But these areas are the outliers. They're not the norm, and anyone shopping in these neighborhoods is understandably confused. The headlines say the market's slow, the data showing prices are falling, and then when they try to buy it feels insanely competitive. So today, I'm going to unpack what's going on in these areas and how buyers can make sense of these competitive dynamics in what is still, broadly speaking, a slow market. But first, let's walk through the February 2026 numbers for the GTA. Now, for those of you new to this channel, my name is John Pasalis, and for 20 years, my team and I have been helping buyers and sellers across the Toronto area make smarter real estate decisions. If you'd like to meet with me and my team, just click the link in the show notes below or send me an email at askjohn@movesmartly.com. Before digging into the trends for houses and condos, I'll start by saying this, that the first 2 months of the year are off to a very slow start. Sales in January and February are down 12% compared to last year, and actually at the lowest level in 20 years outside of the global financial crisis. So people hoping that the housing market would turn a corner in 2026 are going to have to wait a bit longer, because that corner, quite frankly, is nowhere in sight. Now let's begin by looking at the trends for low-rise homes. That's detached semis in row houses. We saw 2,300 sales in February. That's down 4% compared to last year and 44% below the 10-year average. New listings came in at just under 6,000. That's down 16% compared to last year and also 16% below the 10-year average. And interesting, it's the second month in a row where we're seeing double-digit declines in new listings. So we'll see if that trend continues next month. Active listings are roughly unchanged compared to last month, but they're 63% higher than what we typically see in February. Now let's look at months of inventory. A reminder, we calculate the months of inventory by dividing the 10,600 active listings by the sales, which gives us 4.6 months. That's down from 5.3 in January. Now this decline from January to February is pretty typical. Sales usually pick up a bit as we move into February, but what stood out to me was the city of Toronto specifically. In Toronto, months of inventory went from 5.6 to 3.9, a much more pronounced drop than what we saw in the suburbs. And this is where I want to pause for a moment, because months of inventory is probably the single most important metric for understanding what's happening in the housing market now and where prices might be headed. Now, you know, even if you don't love charts and numbers, this is definitely one worth understanding. So the months of inventory is basically a measure of the balance between the supply and demand for houses in any given month. And depending on whether it's balanced or out of balance, we could see prices remain flat or fall or rise in the months ahead. Now, when we look at months of inventory, there are two things we want to pay attention to. First is the direction it is moving in. When months of inventory is trending down, the market is becoming more competitive. When it's rising, the market is cooling. If you look back at the years leading up to the 2017 bubble, you can see months of inventory trending down steadily before prices surged. And same thing before COVID. In fact, inventory, I believe, was actually already falling sharply in 2019 before the pandemic hit, and the ultra low rates in 2020 just accelerated what was already happening. Now, in both of those periods, when months of inventory was at its lowest, under 1 month, prices were rising close to 30% per year. Now, on the flip side, when months of inventory spiked in 2017 to just under 4 months, prices fell more than 20%. And what pushed prices down that quickly wasn't just the level of inventory, it's how quickly it changed. The market turned on a dime, basically. People were caught between buying and selling, suddenly became distressed sellers. Now, since 2022, we've seen multiple peaks and valleys in the months of inventory. These reflect a number of factors, but shifts in sentiment are a big one. Periods of fear push inventory higher, then optimism creeps back in, buyers rush in, inventory dips again. But if you zoom out, the broader trend since 2022 has been rising inventory. Now, in terms of prices, since months of inventory essentially shows us the balance between supply and demand at any given moment, as that balance shifts, prices eventually follow. Now, to make this relationship easier to see, instead of dividing inventory by sales, I'm going to divide sales by inventory, giving us the sales to inventory ratio. It's same data, but the relationship with prices becomes positive instead of negative, and it makes it easier to see and visualize. So right now, we have a sales to inventory ratio of 22%, which is the same thing as 4.6 months of inventory. Now, When that ratio is above 100%, meaning less than 1 month of inventory, those are the hottest markets we've seen prices increasing by 30% or more per year. Now, if we add a year-over-year change in home prices to this chart, we see a clear pattern. As the ratio fell sharply or stayed at low levels, price growth slowed and eventually turned negative. So even though the relationship here isn't perfect, the pattern is pretty clear. Now, the direction we're moving in matters, but the level matters just as much. Yes, months of inventory dipped from January to February, but that does not automatically mean the market's turned a corner. As long as month of inventory stays elevated, say above 3.5 months, we're typically in a softer environment market where prices are either flat or trending lower depending on how high the inventory is. And right now, at 4.6 months in the GTA overall, we're still firmly in buyer's market territory. I hope that brings a little bit more context into how months of inventory impacts home prices. Now, to close out the stats for low-rise homes, I'll end by saying that the average price was $1.24 million last month, down 8% or roughly $100,000 compared to last year, and median prices showed a very similar trend. Now let's move to condos. Condo sales were down 8% year over year and more than 40% below the 10-year average. New listings were down 20% compared to last year. Much like low-rise homes, this is a fairly significant decline, so we'll need to see if this continues next month before drawing any big conclusions. Active listings are down 6% year over year. Months of inventory fell from 8 to 6.6 in February, and the average condo price was $656,000, down 8%, or down about $55,000 compared to last year. Median prices were down about 7%. Now let's pivot back to where we started. If you're shopping in certain neighborhoods in Toronto right now, it does not feel like a slow market. In the broader GTA, over the past 2 months, just over 20% of low-rise homes sold for more than the seller's list price. But in the 4 most competitive neighborhoods in Toronto, which includes Riverdale, Leslieville, and the Beaches in the East End, High Park and Bloor West in the West End, and Davisville in Central Toronto, between 60 and 70% of homes sold for over the list price. Now, that's a massive gap. And before I get the predictable comments, yes, I know that some people are going to say that selling over asking is a meaningless statistics because anyone can price low. But that's not really how the market works. If it was really that easy, every condo owner would list very low, trigger a bidding war, and sell in 3 days. But in a weak market, if you list low, you may simply get offers below your already low price. That strategy of pricing low with an offer date only works when you know demand exceeds supply for that specific property. And in the neighborhoods right now, in these ones, it does. So it's important, however, to really put a little bit of context into this. First, I'd say the bidding wars in these areas are more restrained today than they were in the past. Most of the sale prices are still close to the home's value range. Buyers aren't throwing money around the way they did 5 years ago. And secondly, it's very common for these areas to be more competitive than the rest of the market. That's not particularly new, but I think what stands out to me right now is the magnitude of the gap between these areas and the broader GTA. And I think we can see that more clearly if we compare to last year. Last year, these same neighborhoods were also more competitive than the average, but the difference wasn't nearly as dramatic. Last year, the market as a whole was actually more competitive. Close to 1/3 of homes across the GTA were selling for more than the seller's list price. So although these areas were outperforming the average back then, they were a lot closer to the average. Today, the broader market is weaker, but these neighborhoods are actually even more competitive. And so that divergence is much wider than what it was a year ago. And we can also see this in the speed of sale. Over 50% of homes in most of these areas are selling in under a week compared to 17% across the rest of the GTA. And we look at bully offers using homes that sold for over asking in under 3 days as a proxy. The GTA average is about 3%, whereas in these competitive areas it's closer to 15%. Davisville is about 25%. And interestingly, if we compare to last year, the broader market was actually seeing slightly more houses sell with bully offers, while these areas had fewer bully offers a year ago. So today, the broader market is weaker, but these pockets are stronger relative to the rest of the GTA. And that's why I feel like this divergence we're seeing today feels a little bit more dramatic than it even did last year. So what's driving this? I mean, first, this is not a broad market recovery. This is very highly localized. And what's happening right now actually happens most years. The spring market quietly begins in January, February. Buyers start to search, but new listings are still low. And if you get a concentration of buyers targeting the same desirable areas, you can temporarily create a supply-demand imbalance. And that imbalance produces bidding wars, not because the entire market has turned, but because in that micro market, at that moment, supply is pretty thin and demand is pretty strong. And as we move deeper into the spring market, listings usually increase. Some buyers drop out after purchasing, and that pressure often eases. So if you're a seller in one of these pockets, it may be worth taking advantage of the imbalance while it exists. But if you're a buyer, understand that this intensity is likely temporary and it doesn't reflect the broader GTA market. As always, if you have questions about anything I covered today, please post them in the comments below or shoot me an email at askjohn@movesmartly.com.